Welcome back to Alpha Recap from stockalpha.ai, recorded after the market close and ready to walk you through the week's research highlights. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Lots to unpack from this week. The recurring theme was growth narratives bumping up against premium pricing and a fair bit of execution risk.
Right. And the other thing is, across software, semiconductors, and biotech, analysts kept landing on the same tension. Solid revenue momentum, but valuations that leave very little room for error.
That trade-off showed up in multiple notes. Analysts repeated that a small miss in execution or a macro wobble could move prices a lot, because many names were trading at what you might call elevated price-to-earnings ratios.
So what really stands out here is how pervasive those rich multiples are. Splunk, Okta, Tesla, Danaher, all trading at very high price-to-earnings ratios by historical standards.
For example, Splunk's price-to-earnings ratio landed around 103, which is just a quick illustration of how stretched some of these names looked versus the near-term catalysts they need.
And that number matters because a high price-to-earnings ratio basically says the market is paying for expected growth far into the future. If growth slows, the stock can react sharply.
Exactly. And it wasn't just software. Tesla's forward price-to-earnings ratio was cited in the research as extremely high. That same sensitivity applies there as well.
Right. Let's run through some of the individual notes, just the headlines, and why analysts were neutral or cautious this week. Start with Globe, which felt different because of information gaps.
Globe's coverage was essentially a reminder that not all companies give you enough quality disclosure to build a standard model. The analysts called out that public filings and financial detail were sparse, so they relied on scenario analysis, Monte Carlo-style stress testing, to form a neutral view.
So instead of a single price target, they ran a set of possible outcomes and watched for changes in disclosure as the real catalyst. That's a practical shift when you don't have clean historical metrics.
Short reaction.
I like that approach. It treats opacity itself as risk and as a potential trigger if transparency improves. Moving on, Splunk. We already touched on the valuation, but analysts liked the cloud subscription transition.
They did. The core point was that Splunk's shift to observability and security cloud offerings is creating more recurring, ARR-like revenue. That should help margins over time, but the stock was trading at a price-to-earnings ratio near 103, and the analyst mean target was only slightly below the recent close, at about $150 per share.
So the upside was limited unless cloud monetization and cross-sell really accelerated. In plain words, the business was improving, but the market had already paid for a lot of that improvement.
Right. Okta had a similar framing. Big demand drivers around identity and zero trust, especially with AI projects. But a high price-to-earnings ratio near 109 created the same sensitivity.
And competition from large platform players like Microsoft was flagged as a real risk for Okta. So even with healthy revenue and profit improvements, the market could punish any sign of slowing adoption.
Brief reaction.
Twilio is interesting because revenue had re-accelerated, but profitability was still thin. Their first quarter revenue was about $1.4 billion. And the big event to watch is their second quarter results on August 6th, 2026.
That's a material catalyst. Analysts made a point. If Twilio beat and gave strong guidance, it could reset sentiment. If they missed, multiple compression could be sharp. Basically, event-driven risk with high stakes for the stock.
Exactly. Bill.com stood out as a different case. Healthier cash position, a much lower forward price-to-earnings ratio, and a modest upside implied by the average target.
Analysts highlighted Bill.com's runway and the potential to convert revenue momentum into durable net income. The forward price-to-earnings ratio they cited was about 12, which made it look more defensive relative to the high multiple software names.
DocuSign was another recurring platform transition story. moving from e-signatures to a broader intelligent agreement management platform with AI features, which should increase stickiness.
Analysts liked free cash flow as a downside buffer there. DocuSign's price-to-earnings ratio was around 34, and the mean target implied modest upside. So it was another neutral note where product-led expansion mattered, but execution would determine whether the multiple held.
Biotech had a different rhythm, more binary events. Vertex's recent FDA acceptance for a biologics license application on that new treatment and label expansion in cystic fibrosis were high-impact items.
Right. Vertex's price was in the research, and the trailing price-to-earnings ratio was about 29, with analysts implying roughly mid-teens upside if regulatory and commercialization went well. Those regulatory milestones are classic binary moves. Good news can re-rate the stock quickly.
And Eli Lilly was the outlier, pretty clearly bullish in the coverage because weight loss and oncology franchises were driving fast revenue and margin expansion.
They were bullish. The research emphasized that Lilly had scaled breakthrough therapies into real revenue streams, and analysts raised targets accordingly. But they still noted the usual healthcare caveats around pricing, access, and long-term formularies.
Now, semiconductors. NVIDIA was a focal point. The note reiterated leadership in AI accelerators, but flagged memory supply constraints and data center scrutiny as potential near-term headwinds.
NVIDIA finished the day down about 2%. And the research was cautious that even strong demand for accelerated compute could be capped by supply-side bottlenecks in memory and by customers rethinking data center economics.
That was a sharper than expected call from the analysts. Market leadership doesn't eliminate cycle risk tied to components and capital intensity.
Short reaction.
Intuitive Surgical got a post-earnings pullback that prompted analysts to reevaluate growth assumptions. Procedure volumes and guidance were the focus, since their moat in robotic surgery remains, but recent commentary suggested caution.
Analysts noted the 2-year total return had been negative recently, and the pullback was a chance to watch replacement cycles and service revenue to see if this was a tactical dip or a structural shift.
Danaher was framed as durable exposure to diagnostics and life sciences consumables, but trading at a premium price-to-earnings ratio near 40 made analysts cautious about the valuation if macro or CapEx cycles reversed.
And Tesla, another classic growth versus valuation story. The note emphasized category leadership across EVs, energy, and software, but the forward price-to-earnings ratio was extremely high, implying little margin for error on margins or EPS growth.
Yeah, everyone had that beat the expectations but still high multiple storyline. Which brings us to the cross-cutting themes. Recurring revenue provided some defense, AI was both an engine and a constraint, and biotech was full of binary catalysts.
Let's pause and unpack those themes in plain language, because I think listeners will want the practical implications.
Good call. First, recurring revenue. When a software company converts one-off sales into annual recurring revenue, you get more predictability and higher retention. Think of it like swapping a one-time purchase for a subscription that renews. That helps justify higher valuations, but only if churn stays low and ARPU keeps rising.
Exactly. So monitor ARR growth, churn, the so-called rule of 40, and gross margin improvements. Those signals tend to matter more than headline revenue in these platform names.
Second, AI as both demand driver and bottleneck. NVDA showed that leading the market doesn't make you immune to component shortages like memory, or to customers pushing back on CapEx. So the ecosystem, memory makers, data center operators, matters as much as the accelerator vendor itself.
Third, biotech's event-driven nature. Vertex's BLA acceptance is a good example of a near-term binary event that meaningfully shifts probability-weighted outcomes. Regulatory timelines and label expansions are the high-impact dates.
And then the fourth theme, information asymmetry. With Globe, analysts use scenario planning instead of a single-point valuation. When disclosure is thin, you have to hold multiple possible outcomes and watch filings closely.
Short reaction.
So, what should listeners be practically monitoring week to week? The research team gave a clear list: Twilio's upcoming quarter, Vertex's regulatory follow-through, NVIDIA's memory and data center work streams, procedure volumes for Intuitive, and any filing changes for GLOB.
They also planned primers on scenario planning for opaque names and an AI compute ecosystem map to show how accelerators, memory, and procurement tie together. That kind of cross-sector plumbing is important to understand if you follow the AI theme.
I mean, when you step back and look at this, the main behavioral takeaway is that markets were paying for long-duration growth. Analysts suggested treating near-term results and guidance as high-impact data points because they can swing sentiment quickly.
Yeah, that tracks. Another practical point. In companies with opaque disclosure, improved transparency can be the primary upside trigger, not just better revenue.
Love that. Transparency as an event. Okay, quick segment of short reactions. Right.
Yeah, absolutely.
Before we close, a brief methodological note from the research that's useful for listeners who model companies. Don't rely solely on GAAP earnings. For software, operating metrics like ARR, churn, gross margin, and free cash flow are higher quality signals.
And when disclosure is insufficient, Monte Carlo-style scenario planning and sensitivity tests help you avoid overconfidence in a single forecast. Analysts emphasize that approach for Globe and similar opaque situations.
We should hit the required reminder. This is informational only. Analysts note data and model-driven insights. This episode doesn't recommend buying, selling, or holding any specific security, and it isn't personalized investment advice.
Objective language is key. The research framed many names as neutral because the risk-reward looked balanced, and only one name in the Weekly Digest was explicitly bullish, based on durable top-line momentum.
All right, let's wrap this up with clear takeaways. Number 1. The week's dominant theme was growth versus valuation. Many leaders had stretched price-to-earnings ratios that made execution risk very meaningful.
Number 2. AI remains a huge demand driver, but ecosystem constraints, memory supply, and data center economics created near-term uncertainty even for market leaders.
Number 3. Biotech continues to be event-driven. Vertex's BLA acceptance and Lilly's fast-scaling franchises are examples where regulatory or clinical milestones can re-rate valuations quickly.
Number 4. When disclosure is weak, scenario-based valuation is the right tool. That's what the analyst did with Glob.
And final takeaway, most coverage stayed neutral this week, reflecting balanced risk-reward profiles, with Eli Lilly as a notable bullish outlier.
If you want follow-ups, remember the research calendar. Twilio's quarter on August 6th, ongoing work on NVIDIA's memory ecosystem, Vertex commercialization timing, and procedure metrics for Intuitive are the near-term watch list.
Thanks for tuning in. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
We'll see you next week on Alpha Recap. Stay curious and remember, data suggests, analysts note, and the markets decided today was what they were willing to pay.